This is Mike Zlotnik, Big Mike, and I'm joined here by Paul Kiebler. Hey, Paul.
Morning, Mike.
Thanks for joining us, Paul. Paul is Chairman and CEO of Pike, our partner on many deals, and we're going to provide you with a quick update on the general state of the market first, what's going on in Midwest, and we'll talk about that. And then after that, we'll have a few separate discussions per project by project. We'll have individual updates, and we appreciate your time and attention. So, Paul, let's dive straight into the discussion. So what's going on? What's been going on in the real estate, commercial real estate, or multifamily real estate, to be specific, industry? Talk to folks a little bit, kind of, let's just call it that average Joe can understand, doesn't require a PhD in economics.
Sure. So, in the Midwest, the multifamily market is a little bit more steady than some of the other markets, the Phoenix, the Southwest, Southeast markets. But like all markets, the multifamily market went up, 2020 to 2022, we saw some inflation. 2023 interest rates obviously raised significantly and cooled off a little bit, got a little bit more stable. Cap rates, which converts the NOI into value, cap rates went up. So there was a little dip in pricing because of that. And we're hopeful that, rates will ultimately stabilize here in the next year or so and, lower cap rates and increase the value some. But as far as liquidity, we're seeing about 40 to 50% of the transactions that we saw a year ago. So there's a little bit less liquidity in the market, but there's still interest. I probably got 3 or 4 emails a week asking to buy a property. So there's still interest in the market, but I think pricing is down probably anywhere from 10 to 20% from where it was a year or a year and a half ago.
So Midwest market, again, being more steady Eddie market, is experiencing 10 to 20% correction, while some of the southern markets, I've seen articles, some of those properties experiencing, I don't know, 20 to 40% corrections, in some cases even more. They're a lot more volatile. Like the Phoenix is a very challenging market. So Midwest feels like it's a lot less of that, but there's a correction, of course, in the prices.
Yeah, I have investors that also invested in projects in Phoenix and things like that, and their equity is wiped out. If rates come back down and cap rates fall and, they're able to create some more value, that may be a temporary situation. But right now, in the Midwest, we're seeing about a 10 to 20% decrease in value on average across the entire portfolio. But we're also hopeful that if rates can get back down to that 3.5, 10-year at 3.5, we'll see some increase back to where we were. So we do like investing in the Midwest because of that steady eddy. It allows us to have.
Yeah, Paul, I appreciate that. So that's on the valuation front. But what's going on the liquidity front? So the Fed push rates. I have an article out, and I don't know how else to put it, but I call Fed the biggest drug cartel or drug dealer of them all. I don't know how else to call it. They accustomed us, addicted us, all of us, to ZIRP, zero interest rate policy, for many years. Some people say 15 years, 20, but long period of time. Since 2008 until just pre-COVID, the interest rates were very, very low, at zero effectively. And then they tried to push it up a little bit, and COVID hit, and they dropped them back again down to zero. So that they addicted the market to very low interest rates. And then when COVID hit, the whole inflation blew up after the government printed trillions of dollars. Suddenly, Fed started moving the rates fast and furious up. And then they moved us up from 0 to 5.5 in about, what, 15 months, plus minus. So they withdrew the cocaine, and then the market is experiencing that. But what's happening on most of your investments? You borrowed when the rates were zero on the Fed funds rate, and then had some kind of bank spread, and then things went up a lot. So just talk a little bit about most of your deals that you've seen with the floating rate debt, most of the projects that you financed, and the entire value of the industry financed with floating rate debt. Unfortunately, you couldn't borrow fixed rate debt. You had to go with variable rate debt.
Yeah, so the in the value add world, we do a floating rate debt because we're not sure when we're able to sell the property. Again, the whole premise or business plan was to buy the property, create the value, then sell the property. And if you had a fixed rate loan, you couldn't sell the property. You'd have to wait for the full 10 years to capitalize on that increase in value. So the floating rate debt is, almost 100% of the value add properties were financed through that floating rate debt. And a lot of these properties had spreads, which is the rate on top of what the LIBOR rate was or SOFR rate was of 3 to 4%. So at the time, if LIBOR was 1% and we had a 3% spread, our all-in rate was 4%. Well, when Fed funds or LIBOR went from 1% up to 5%, we still had that 3% spread, and that made our rate go from 4% all the way up to 8%. And 60% of our cost is through debt. And when 60% of your cost doubles, that basically gets you up to 120% of cost, or actually more cost than you have revenue. The other negative thing that happened to us was inflation on the construction materials. Those went up about 20% over the last 2 years. And that was, rate driven as well. So by the Fed increasing that rate from effectively 0 over the last 20 years up to, 5.5 over the last 15 months, our costs, both for interest costs as well as, the materials, construction materials and things like that, went up dramatically.
Yeah, appreciate sharing that. And that financial pressure is far greater than the pressure from the inflation, cost inflation, because your cost of money just went up, doubled, in some cases even higher. So that is a tremendous pressure. So
And that cost of money was a larger percentage of our overall cost. So if something else would have doubled and only represented 5% of our total cost, that would have been bad, but it wouldn't have been as bad if 60% of our total cost doubled. So the interest was very, very bad for us.
Yeah, it's a lot of pressure. And so let's talk a little bit about rate caps. So some projects, or most of the projects, you bought rate caps, and many of them are expiring. And this is an industry-wide issue. So just to be very clear, all these issues are tsunami wave that hit the entire industry. It's not just us. The interest rates are impacting the entire country. But let's go back to the rate caps. Many banks are requiring fresh rate caps, right? And the rate caps, when you bought them, they were cheap, but now they're a lot more expensive.
Yeah, so the properties that we're talking about today all have rate caps on them. They were at 3, 4, 5%. And at the time they were relatively inexpensive. But today, because of the higher rates, they've quadrupled, sometimes even more than that in cost to replace them.
So ultimately, what's happening right now? Many projects need liquidity because the pressure from all these things that we just discussed is putting these projects in a position they're running out of cash, right? I don't know how else to put it. So the critical need is to raise liquidity to be able to support and sustain these projects to get them to the finish line. Is that the state of the market?
Yeah, no, that's perfectly stated. I think there's still a lot of value within the portfolio. The markets that the properties are in are still, very stabilized. We're in the middle of the renovation project. Liquidity is either gone or running very short. We just need the liquidity to allow us to keep current on the loans, keep current with the contractors, and then finish the project. Our rental increases that we originally projected, a lot of times we're beating those, so we're creating the value that we thought we'd originally create. It's just a liquidity issue of staying current with the banks and staying current with the contractors and suppliers so we can continue to renovate units and get new people in there at the higher rates.
Yeah, and I appreciate you sharing this. And the reason it's very important is that obviously liquidity challenges are creating the opportunity. And the opportunity is to invest fresh capital into these deals. And you reached out to us in about December of 23 and said, here's a portfolio of properties that need liquidity. And we're working to underwrite them to provide liquidity for all these projects. So from that perspective, the opportunity is that in order to finance these projects, in order to bring fresh capital, let's just compare and contrast this approach where we are putting in, let's call it mass financing on these properties. The mass financing, what it does, it basically goes behind typically the primary debt, the bank loan, and then pushes all previously invested money back. And it's not fun for existing investors. But at the same time, all existing investors will have an opportunity to participate in this mass debt. The reason it's important is that we certainly want to give every existing investor every opportunity to participate in this mezz debt. Not only that, I think it's the most elegant way to do this versus in some situations, sponsors have been issuing capital calls. And I'll just give you my 2 cents on the whole capital call story. So when they issue capital call, they go to all investors and say, we need capital to keep the projects afloat, which is an option. But half the investors may decide, I don't want to participate. I either unwilling or unable to finance for whatever reasons. When that happens, you can't reach the capital that you're trying to raise because half the people willing to participate. So what do? And then also when folks issue capital call, that money doesn't come in kind of as a last in, first out. So the alternative to doing that capital calls is to come up with this new system, which we are basically calling mass financing, but it works as a last in, first out, kind of like a LIFO, it's the term. And that money comes in and everyone gets a chance to participate in that capital. And if someone doesn't want to participate in that mass financing, they don't have to, but they have to understand that by not participating, their money still gets pushed back on the capital stack to the fresh capital that's coming in. Any quick comments on this? Just wanted to hear your thoughts on this.
The mezz capital that you'll be raising for us, does sit right behind that senior loan. But a lot of times that's, 60, 70% in the capital stack compared to the as stabilized appraised value. So, it's lower in the capital stack. There's a lot of common equity behind it. But also for the common equity holder, the mezz provides value to that. So without this mezz, the common equity won't be worth as much as it will be worth even diluted after the mezz, because this mezz actually will create more value within the property and the common equity will share in that ultimate value. So, like a property that, can't move people in because it doesn't have liquidity to finish the unit, those units will sit vacant and won't create value for the property. As the property creates value, it'll create value to the common equity holder. So while the mezz certainly does sit in front of the common equity, it does help the common equity by creating more value within the project, and the common equity owns the back end of that value that's created.
Yeah, and I appreciate that explanation. And you're putting it in a very diplomatic way, and I'll put it a little bit more tougher, that if the capital is not raised, these projects are not brought to the finish line, or they run out of liquidity, can't pay the debt to the bank, and can't renovate these units, they can fail. And all equity could be lost. All the previous invested money is at risk without the liquidity. So projects can die from lack of cash. And that's a very important point that current investors need to understand, that given the tsunami wave that hit us, a lot of the past invested dollars in 21 and 22 are living on thin ice. I don't know how else to put it. And this mezz debt is a way to give these projects critical capital to get them to the finish line, to be able to pay the debt, to be able to renovate these units that are stuck right now without liquidity. And ultimately, the goal is, of course, to help all previously invested dollars. So exactly what you said, without the liquidity, it doesn't matter because these projects can get to the finish line. That's the key message here.
Yes, absolutely.
So that's about it. And we're working on this, the way to provide this capital for Pike. We're working on, Tempo is launching a new fund called Tempo Advantage Fund LLC. That fund is the primary vehicle to provide financing, and its primary focus is Pike portfolio of assets. A number of these projects we've previously invested, so we were familiar with them. And some projects a little bit newer to us, but we're reviewing and underwriting all these projects. So again, to learn more about Tempo Advantage Fund LLC, if you're an existing investor in one of these projects and want to participate in this mezz financing, you're welcome to reach out. The terms, we believe, are very, very strong terms on a risk-adjusted basis. Of course, read the PPM. This is not solicitation. This is purely informational, educational. Read PPM, review PPM, consult with your financial professionals, but reach out, at least ask for the information. We're happy to share. And that's about it. Any final thoughts on this discussion? Anything else, Paul?
No, I appreciate you helping us out raising the mezz money. I think that's very accretive to the properties. They're going to help. This money is going to help them get to the finish line, create the value, and allow us to exit. So appreciate all your help in that, and appreciate the investors having faith in us.